I've been afforded a few minutes to preface the impending panel discussion with some steer on this new world order. Geopolitics is no more a background risk. It is now at the core of decision making. I think many would concur that while historically we would lean towards economic data to make decisions, now one also has to incorporate political intent. Mark Carney, about a month ago in Davos, was quite abrupt. He said the quiet part aloud. He signaled this is not a transition, this is a rupture. And we interpret that rupture to mean that from yesteryear's rules, institutions, and benign multilateralism, we have perhaps shifted to a world where power, weaponization of economic tools, and even coercion is now the order of international engagement. Africa has probably never been more relevant geopolitically, whether it is through the lens of its abundant commodities or the opportunity to fill the vacuum increasingly that is afforded by the dialogue of reshoring, friendshoring, and nearshoring. America is exceptional. It's exceptional for its economic heft, at about a quarter of global GDP, for its share of capital markets, global capital markets. Indicatively, American equities account for 62% of global equity. That's astonishing. Of course, the dollar has been a significant underpin to America's wider hegemony. And then, of course, there is America's military prowess. America will this year spend more than $1 trillion on its military complex, typically more than 3 times that of China, and as much as the 9 next largest military spenders combined. Some would say this is not just deterrence. If we look at the last couple of decades and America's active engagement around the world, its widespread bases and alliances, one would argue that perhaps America has a proclivity for engaging militarily. But for all of these elements of exceptionalism, which we don't think is necessarily going to come to conclusion or going to end America's dominance, what America lacks is the upstream supply chain of modern materials for new age goods and perhaps even services. China, at least with respect to rare earth metals, aluminium, to a degree copper, and even lithium, dominates. History with respect to the Industrial Revolution guides us to believe that those nations that were at the forefront of the innovations and technological frontier of that time would dominate global affairs, not just for decades, but for centuries. Perhaps artificial intelligence is today's spinning jenny, and those that control the rare earth metals and the other inputs into the ecosystem to be able to produce the hardware and create spillover to the software will dominate. So activities in Venezuela or Greenland are deliberate. They speak to what America lacks, and it speaks to China's advantage in the current era of technologies like artificial intelligence, immersive reality technologies, and even quantum computing. And China is somewhat prepared to the extent that it's insulated. Over the last couple of years, this trend towards not deglobalization, but trade becoming more regional, trade becoming more local, has also featured in Asian affairs. 30 years ago, less than half of all of Asia's trade was intra-region, intra-Asian trade. More recently, it has risen to around 60%, and we think by the end of this decade, intra-regional trade across Asia will surpass 70%. That speaks to this buffer that China has built, and Asia more broadly. So trade is maturing across Asia. Supply chains are increasingly strengthening across ASEAN and, of course, North and South Asia. We're not suggesting at all, as I did a moment ago, and to confirm, that America's exceptionalism is about to be confronted, or at least it will be confronted to the extent that there is now other parties and more voices in the game, in town. And America will therefore enter this period of geopolitical contention. What was remarkable about last year was that global growth was steady. This references 2025 GDP growth and forecasters' views month on month through the year. It's astonishing if you consider that global growth ended more or less in line with January, February estimates. In other words, the global economy hardly stuttered, despite all this geopolitical buffer. And I guess that speaks to a few things. It speaks to the adaptability of the global economy to shocks. It also speaks to this tilt to lower inflation, which unleashed an almost synchronized global monetary policy easing, creating easier financial conditions. Emerging markets performed handsomely, aided by a preference for investment flows flowing towards emerging markets and somewhat of an aversion to developed markets, including the United States. And of course, buoyant commodity markets created a virtuous cycle in many emerging economies, and especially on the continent, helping to engender steady, if unspectacular, but steady economic growth. And perhaps that sets the scene for 2026. Steady, if unspectacular, but welcome steady growth. Buoyant commodity markets, which will be a fillip for especially the continent, and generally easy monetary policy. But that shouldn't mask the fact that geopolitics has materially shifted, and as Mark Carney suggested, a rupture. And so this panel will engage on how we think that rupture is going to unfold, and perhaps with the leitmotif that I suggested a moment ago. Africa has never been more geopolitically relevant in at least the last 30 years. Thank you. Gugu?
Gulam and I will not be engaging in conversation in isolation. We'd also like to welcome up on stage two of our panelists joining us, Dr. Michael Power, Managing Director of Kazi Consulting, and Ms. Yvonne Mango, Africa Research Economist at Bloomberg. Please give them a warm round of applause as they make their way up on stage to join us for a seat. Yvonne, feel free to have a seat towards my left-hand side, please. Mr. Power, glad to have you. You can have a seat in the middle. Thank you kindly. This is probably the one panel discussion that I believe is very exciting for everyone, because all of these thoughts, the headlines, the themes, the discussions, the threats, the concern, I'm sure have left us all feeling exasperated in the last 2 years, right? Right? Or maybe I'm wrong. But that's the point. There's so many thoughts and so many themes to actually pull at in terms of understanding where we are within this particular cycle of not only geopolitics and macroeconomics. Gulam, you've highlighted so many critical themes, and I think there are quite a few that stand out. Your last point, that Africa has never been this relevant. I believe, Mr. Power and Yvonne, this provides you both with an opportunity perhaps just to reflect your observations and your thoughts on some of the highlights and insight that Gulam has shared with us this morning. Yvonne, your thoughts, I guess, as an economist who focuses on sub-Saharan Africa, you're quite optimistic that this is good news for the region.
It is encouraging, though, of course, we'll have to be strategic. And thanks to Standard Bank for inviting me to this forum. So firstly, as Gulam mentioned, we've seen a shift in terms of moving from this US-led globalization into contested multipolarity that we're seeing, whereby we now have multiple powers that are now actively coexisting, and likes of the EU, India, China, as well as the middle powers that Gulam mentioned, including the likes of Turkey, Brazil, but having to now operate under different rules of engagement and influence, and all that's being actively disputed. And we're seeing this play out in economics, and in geopolitics, in trade, and in security. That's what we're seeing at this point in time. Of course, that has implications for Africa, which we'll continue to delve into.
Definitely. We'll definitely pick up on some of those themes, especially just in terms of which regions, markets, countries are getting it right, but also most importantly, the policies that we need to unlock, the capital that also needs to be invested. Mr. Paham, I'm quite keen to get your thoughts and perspective as well, because quite a bit was shared, but naturally a turn in the tide. But your reflections on the presentation we had from Gulam, and maybe this is an opportunity for you as well to pry a little deeper to some of the thoughts he shared.
Thank you very much, and thank you, Standard Bank, for inviting me. As Gulam always knows, I don't ever follow the crowd. I tend to look at things somewhat differently. One of the big phrases that we've heard in the last year is deglobalization, and I do think that the world is not so much deglobalizing as reorienting. And do remember that for 20 of the last 22 centuries, according to the great Angus Maddison, Asia's been the center of economic gravity in the world, and I think the status quo ante is being restored, and so the moves going on at the moment are secular. I think that when we think about this reorientation, we need to move away from what is central to this particular conference, which is capital, and start focusing more on trade. The US-centered world is obviously driven by capital, as was shown in the list of questions we've just been asked. There wasn't a single one that mentioned anything to do with China. But China controls the world of trade, and I think that is something that is particularly central to Africa's future, because I think, with the exception of Eswatini, every country in Africa has as its number one trade partner on both fronts, China. So I think it is an important consideration. The best prism to start viewing the changes that are taking place at the moment is not through the capital account, it's through the current account, where the trade is captured. Now, this is not familiar to most of the people sitting in this room who probably live and work in capital markets, but it is something that you need to pay far more attention to moving forward. This means stop being hypnotized by the dollar. I would have loved to have seen the question today, not on what the dollar is going to do against the euro, but what it's doing against the renminbi, which this year and over the last 12 months has been far more significant than the moves that it's had against the euro. So this is all part of the change in the way that we need to start looking at the world. I would strongly encourage central banks in Africa to start denominating their foreign exchange reserves in two currencies. Tell us from month to month what happens to the dollar amount and what happens to the renminbi amount, because that way we can start to understand the world that we're moving into. We're moving out of a world that is centered on US capital. And remember, the US wants capital from the world. It doesn't give capital to the world. It runs a current account deficit of $800 billion, which means it must attract $800 billion into the United States in order to balance its external account. It's not a net contributor to the world of capital. If you want to look at who a net contributor of the world of capital is, it's going to be China, because China's running a current account surplus of $1.8 billion a year. So it's a mind shift that is going to be very uncomfortable for us, but particularly in Africa, where we're on the front line of the battle that's taking place for influence between the US and China. Be on guard. And I thought I'd just
Michael,
give you one anecdote.
Sure.
The end of last year, Kenya switched 70% of its railway debt from dollar denominated to renminbi denominated. 1st of January this year saw its credit upgrade. Why? It saved $200 million on its external payments by switching to China.
Valid points that you've mentioned there, Michael, and thank you for giving us some perspective. This is where I'm hoping we can roll up our sleeves and deep dive into the conversation with your assistance as well as audience members who have key questions and themes that you'd also like to engage on. So please do be mindful that we will be taking your questions both in the room and online and addressing them to you. I think we're all sitting here and we're thinking, my goodness, several themes that we have to clutch on. First things first, perhaps let's focus on the trade dynamic that has been highlighted. And this, I guess, is addressed to all of you as panelists, but perhaps starting with yourself, Michael, given the opportunity that you alluded to, AGOA has been extended for the next, 12 months, till the end of the year at least. And as you've mentioned, the new trade partnership between China as well as 53 countries on the African continent. Many have said that this offers great opportunities, as you've highlighted, but there almost seems to be this balance we need to strike in the structural shift of improving our trade, moving to a surplus, but at the same time mobilizing and capacitating the industrialization of markets on the African continent. Help us understand how we strike for that dynamic. And I say this because many have raised a concern that our areas of weakness shouldn't shift from trading too much with one region over another region, but maintaining optimism and growth across sub-Saharan Africa.
Well, aside from recognizing the shift that has taken place, and not enough of us do, I think we have to understand that there is a huge challenge facing Africa at the moment as a result of the rise of automation in the global economy, and automation which is again being led by China. Now, 5 years ago, if you'd heard me at this conference, I would have been arguing for the growth of low-end manufacturing in Africa so that it could essentially move up the value-added chain, start exporting, as Lesotho has been doing, textiles to the world. It's becoming more difficult to do now. Automation is not helping the shift, and you can see it even within the Southeast Asian region, of manufacturing from China to the rest of Southeast Asia has been marginal. Yes, they may gain on lower labor costs, but they haven't been gaining on lower production costs, overall production costs, including labor. That is still, generally speaking, happening at the lowest cost in China. And the Americans have started to realize this too.
100%, and that's a major concern as well, just in terms of how best it is that we tap into that opportunity. Gulam, I'm keen to have your thoughts come through in this conversation because it interlinks then to the theme regarding infrastructure. So perhaps both yourself, Yvonne, and Gulam, I'm shifting the conversation to focus on that critical investment that we need to make in infrastructure. And perhaps I highlight this because it also came up just last night in the cocktail engagement with members of the creative industry who highlighted access to digital infrastructure does make us competitive in terms of the creative industry overall on the continent. To help us unlock the interlink that does need to take place even further here regarding our competitiveness in certain sectors and how that speaks directly to infrastructure investment, but the innovative ways of funding that we need to implement.
Kuguletu, so a few things, and if I may just preface that also with alignment with Michael, even though his suggestion was maybe I would be contradictory. So a few things. Trade is about 50% of Africa's GDP. So it's been the quiet engine that has been engendering quicker growth and been a source of prosperity and per capita incomes. 7 of the world's 10 fastest growing trade corridors now exclude the US, and they involve Africa, the Middle East, and the Far East. And so there is Africa's opportunity for insertion. Africa is potentially at great peril to the extent that it has been unable to establish heavy manufacturing. And the language is routinely that Africa must insert itself into global value chains, from shifting rocks to shifting products, from being able to, on the back of nearshoring, friendshoring, to become a trusted partner in this geopolitically fraught world. And the difficulty is that China, and sometimes China plus one nations, are establishing themselves dominantly in new age production. And we know that to be perhaps most prominent, for example, in BEV vehicles, battery electric vehicles, and other new energy technology products. And Africa is going to be left behind in this third chapter of China's manufacturing ascendancy. Quickly, the first chapter was low quality but cheap goods. The second chapter was high quality and still cheap goods. And now the third chapter is new age products. So if Africa is going to establish itself as an attraction for the next factory, the next smelting and processing plant, the next mine, a few things must happen. The regulatory, the policy environment must be more inviting.
Yep.
Reforms with regard to foreign exchange so that liquidity is ample and individuals and foreign investors can invest not just in portfolio arena, but also in the real economy. Power has been decapitating for a length of time. Across Africa, the extent of power availability is the equivalent of some single country Western nations. It is so scarce, and power, of course, is oxygen. But that has been improving and improving measurably, and especially with regard to more modern solar-oriented options. But the reform agenda with regard to enhancing the investment climate on the continent, the capacity to enhance predictability, even if it isn't perfect, needs to improve. But even though I sound a little bit hesitant and daunted, in 2022 and 2023, the Middle East invested about $113 billion across Africa in ports, in energy, in infrastructure, in retail, hospitality. And that was 3 times as much as China. So the Middle East is, while a middle kingdom, it's a superpower with respect to capital. And to conclude, with regard to the infrastructure opportunity, at Standard Bank we talk a little bit lyrically about this arc of prosperity, Africa, the Middle East, and the Far East, creating this arc of 2/3 of humanity, new sources of capital, new trade corridors, and perhaps commercial trust against the backdrop of fraught transatlantic ties and a muscle posture by the United States.
Got you. Many themes that have been mentioned there, but really do provide us with a critical understanding of not only some of the threats, the opportunities, the concerns, but most importantly, how we get this capital flowing. In a moment, I do want to come to you as the floor to ask some of your questions to the panel, but I think there's so much that has been highlighted, that it's not just about the East versus the West, but of course, opportunities with the Middle East. Of course, finding that there's an increase in terms of capital that is coming towards the continent. But Yvonne, this is where you come in to help us elaborate whether this financing is being costed correctly. And I ask this because we're well aware that in certain regions there's been a heightened level of investment, at times reforms that have been implemented as well to make some regions and countries more competitive. But what are we seeing in terms of the capital inflows, the pricing, and is there a shift in terms of how that view or risk is being analyzed in sub-Saharan Africa?
So countries that will still enjoy significant capital inflows are those that have established macroeconomic stability, where we see credible and policy discipline.
Can I push you on that one? And give us a region, give us a country. As we heard, there's a lot of optimism and some excitement around where that is.
I think that it's a few factors. So where we're seeing reform stories, I think it was mentioned when we had the poll earlier that West Africa will outperform. And I think that's a reward to the significant reforms we've seen in the region. In Ghana, it's through debt restructuring. In the case of Nigeria, it's deregulation of the foreign exchange and the petroleum sector, and that we're beginning to see the economy now pick up in terms of its performance and the currency appreciate on the back of it, as well as inflation come down, allowing for borrowing costs to decline. So in West Africa's case, you are seeing the case of reform story. You mentioned earlier gold and what that's done for that economy in terms of the currency, as well as bringing down inflation to as low as the single digits. We had it over 50% just over 3 years ago. So certainly a reform story represents or presents upside for investors, and that's what they want to see. High growth and diversified growth. I think that's what East Africa tends to offer the continent. It's growing at close to 6%, significantly higher than 4% for the sub-Saharan Africa region. And I think you continue to see investment going to logistics in that area, the tech sector, which remains pretty attractive, export-based infrastructure. So East Africa continues to attract investment. So my first point is that macro credibility is where you'll see capital inflows go into. In the new global order, strategic assets are important. Also, we've spoken to critical minerals earlier. Countries such as the Democratic Republic of Congo are certainly benefiting with large reserves of copper and cobalt and the energy transition metals. Countries such as Zambia in that regard. In addition, when I speak of strategic assets, not just speaking to commodities, but also logistics, ports. We've seen a lot of interest from the Gulf in our ports, in particular in East Africa, and I think that also supports that. But also increasingly now in the world that we're in, digital capacity and institutional capacity, digitization is seen now as a multiplier for traditional fundamentals. So, for instance, in the case of Africa, if you have digitized governments, that improves your revenue, improves the fiscal resilience of those particular countries. It helps in terms of expanding your export potential in terms of tech as well. So I think those particular factors are where you see capital being drawn. So macro stability will determine whether you get inflows, capital inflows. However, if you see digital capacity improving in particular countries, that will determine how much you will get and the type of capital that will flow in that particular country.
Important points that you highlight, and I do want us to come back to the theme around technology and digitally enabled in just a moment. I do want to take the liberty of just double checking with the floor if there are any questions. We're more than happy to hear your thoughts. To the governors of central banks, I hope you've been paying attention to some of the themes that have been shared, and maybe this is your opportunity as well to share your perspective on some of the themes that have been highlighted. By show of hands, any questions from the audience? Please feel free to raise your hand up high. Your hand has been noted, sir. I will kindly request that you keep it up a little higher. It's just easier for my colleague to identify you. We're happy to take 2 more questions if there are any available in the room. Thank you so much, sir. Please go ahead and introduce yourself.
Thank you. My name is Bankole. I'm with the IFC. It's more for Dr. Power. So I can relate with African countries that import a lot from China, moving significant portions of their reserves to renminbi. But I would like to hear your thoughts on how they manage the fact that liquidity is still quite low in the currency, and there are capital controls, which makes it more difficult to use it as a reserve currency.
China is not in a hurry to become de facto one of the world's reserve currencies, though Xi Jinping last month did say that it was a medium-term objective of China to be one of the world's reserve currencies. And yes, to do that, they will probably have to find ways of opening their capital account to a greater degree. That doesn't mean that they go full no exchange controls day one, but they can do, and are already doing, small adoptions. We are beginning to see, for instance, through the digital yuan, the opening up of trade to currencies other than the dollar. And the yuan is putting itself forward as a player. It's becoming a very significant player in the oil market where the US is not involved on one or other side of the trade. So I do think that this will be a gradual process. I have to say that I have done a lot of work on the pluses and minuses of being a digital currency and a reserve currency, and I don't think they're all pluses. I think you have to be very careful before you embrace that one, and I think China is being very careful before it rushes headlong into the idea of saying we want to be the world's #1 reserve currency. They're not going down that path. Yes, they have a closed capital account, but that doesn't stop money leaving China to invest in the rest of the world. I mean, a nice example, and it somewhat relates to some of the other discussions that we've been having already, is that Chery has agreed to buy the Nissan plant just outside of Pretoria to assemble cars here in South Africa. BYD is strongly rumored to be looking at buying one of the assembly plants around Port Elizabeth. I don't know which one. Some people probably have a better knowledge than me. Both of which required permission for those two companies to take money out of China to invest in Africa. So it's not as closed as many people might think, but it's not open in the same way as the US. But let me just remind you, the US, the flow of capital is not from the US to the rest of the world, it's from the rest of the world to the US. In fact, last year, 60% of the world's mobile international capital flows went to the United States, a country with 4.2% of the world's population. 60% of the world's mobile capital net flows went to the United States. How do we know that? Because the US had 60% of the world's current account deficits. It's an equation that has to match. So when we think of the US dollar and we think, oh, the US, where's that US money coming to Africa? It's not on a net basis. It's going from Africa to the United States. From China, it's not flowing hugely. But if you look particularly in terms of their investment into infrastructure in Africa, and it may not be showing up on, for instance, things like stock exchanges or bond markets, but for instance, the Tazara Railway has now being rehabilitated, had originally being built by China under Mao Zedong. It is now being rehabilitated by China. And we're seeing a lot of the infrastructure up, particularly the east coast of Africa, being essentially rehabilitated or in some cases built anew, funded by China. And so that is capital that has to be leaving China in order to achieve that. I honestly don't see very much of that happening out of the United States.
Got you. Happy to take two more questions from the floor, if there are any right now, as we build up on some of the themes. Any questions?
One over there.
A little higher? There we go. Fantastic. Please go ahead with your question, sir.
Morning, everyone. Louis from Momentum Group. I would like to hear your views on what you believe Africa's value proposition is in the context of AI, and how can we strategically position ourselves to get the best for ourselves in this geopolitical world? Thanks.
Great question. Is it directed to anyone in specific? Because I can tell, Mr. Power, this is one that you look keen and eager to go for. But Gulam, feel free to add your thoughts.
If you want to add, and I'll add on something.
You want to lead?
I don't mind.
Okay. By definition, the continent is prone to leapfrogging. The continent is, for example, bricks and mortar shy. And so it cannot develop in the traditional models of, say, in the financial services industry that delivered financial services through infrastructure that is more analog instead of digital. In the same way that we've leapt from 30 years ago, near zero mobile telephony to more than 900 million connections. And still with the extent of fixed line telephony that existed in 1990 being about that level now. So it lent itself to the adoption of mobile telephony simply because, as I'm suggesting, it was going to generate diffusion at a lower cost and bypass the inability to deliver banking service in a more traditional mode. You've got substantial demography. You've got one of the most significant network industries that has established on the continent is telecommunications. And that means the capacity for, as I said, diffusion, wide and deep, means that the veins of the system has already been well established. Admittedly, the quantity of investment that is flowing into investment in AI type of activities and infrastructure, commercial infrastructure and commercial activities is still shallow. It's about less than $10 billion currently, and it tends to be sprinkled more across the eastern corridor than elsewhere. However, given the proximity of the continent in terms of time zones, it's, as I suggested earlier, the capacity for establishing commercial trust across the West and the Eastern markets means that over the ensuing years, the ability to establish itself as a bed for artificial intelligence development and for providing safe services to the rest of the world, as well as the raw need on the continent to use artificial intelligence as a developmental mode, is ripe. And just to conclude, mobile money transfer was invented on the continent. One, out of necessity, and quite simply the second, because of the capacity of the continent to pursue that with vigor, meaning the skill sets are abundant. So I think we're likely to be surprised on the upside in the ensuing years with these technologies finding commercial relevance in an endogenous and an idiosyncratic way, and as well as the continent being an exporter of artificial intelligence services, modern technology services, frontier services to other parts of the world that are going to look for that friend-shoring, safe-shoring of international supply chains as they shift towards predictability and resilience rather than efficiency. Michael?
I think what we need to understand is that there are two philosophies towards AI in the world at the moment. One is the US philosophy, which is that you essentially have to pay $20 a month to have a subscription with Google. And the other is the Chinese philosophy, which essentially means that you access AI for free. One is called closed weight, the other is called open weight. The interesting thing about it is that added to the open weight being free, it is also much more connected to what is called the edge in AI. And the edge is essentially my mobile phone here and the other 900 million mobile phones that probably are in Africa at the moment. The Price Waterhouse did a study just before the new year on adoption of AI all over the world. And unquestionably, they saw that Chinese AI was being adopted far more quickly, not just in Africa, Latin America, Middle East, Eurasia, Southeast Asia, essentially everywhere but Europe, Japan, Korea, Australia, New Zealand, United States and Canada, that the open weight model was winning hands down. Now, the fact that it is free is an incredibly powerful impetus to its adoption. And I cannot see the US model of monthly subscriptions catching on, particularly in Africa. I think that there is a battle royal going on between the so-called large language models of Gemini and Grok on the one hand, and DeepSeek and Qwen from China on the other hand, and that will be resolved in the next couple of weeks. And I think we're going to see some big changes coming. And I think open weight will win.
What I'm keen to build up on, especially given the theme of AI and technology, and as you've highlighted, there's some aspects that we need to be mindful of that play a critical role in terms of the infrastructure, the user experience, but one can't separate the theme of AI with energy. Energy to the critical minerals, those critical minerals on the African continent. And that even speaking to the theme of sustainability and what that looks like going forward. Are these conflicting views that might continue to perhaps then raise challenges around our focus and our competitive advantage regarding AI? Michael?
I think that although there have been some, in inverted commas, victories for the United States, perhaps in the DRC, in the critical mineral space, that by and large, China is far more embedded in the critical minerals industry of Africa than is the United States. The problem ultimately comes down to the fact that in China, they can direct companies to pursue their national agenda. In the United States, it's become very difficult for them to identify which companies they're going to push in order for them to be involved in the DRC or wherever in the extraction of coltan, for instance. So I think that we have an interesting, again, it gets back to a difference of philosophies. And I think that as we're seeing pretty much on the mining side, but also critically on the refining side, the Chinese model is winning hands down at the moment.
Sure. Gulam, go ahead.
Guguletu, so I think everyone in this audience is well aware, for instance, that initially America sought to preclude China's access to NVIDIA's more superior chips. And the combination of algorithmic efficiency, open source engineering, and system optimization has allowed China to close the gap in terms of its more deficient microchips and its capacity to deliver computing outcomes in line with the United States. And hence, you could argue that is why the United States ultimately did not use the preclusion of China's access to NVIDIA chips as a tool, because China, in fact, were able to optimize that Formula One car with a weak engine and be able to keep up with an American Formula One vehicle, or at least close enough. And I think in the manner of African trade ties with China, technology diffusion, technology adoption, 2026 is going to be marked by accelerated, to use that word one more time, diffusion. There was suggestion from one of our colleagues earlier on that all of this investment that has gone into artificial intelligence may not generate the cash flows.
Yeah.
The other salient figure at Davos was, of course, Satya Nadella, who spoke about that it is a bubble in artificial intelligence if artificial intelligence productivity and usage remains confined to predominantly the tech firms and to rich markets.
Sure.
And maybe not over the next few weeks, as Michael suggested, in terms of who wins, in terms of winner takes all, large language model prowess, but in terms of diffusion, 2026, and African diffusion, I think is going to be the hallmark year in that respect, aided by the China model versus the relatively more closed, priced American model.
Moving dynamics that we do need to be cognizant of in terms of these themes that have been highlighted. I'm aware that we are slightly under pressure for time, but I don't want to ignore another concept that is critical in terms of the conversation we're having here today. Yvonne, as you've highlighted, we need the policy certainty. We need to ensure that we do have viable environments. Whilst trade is also opening up to the continent, we need to ensure that the necessary infrastructure investment to facilitate manufacturing and our competitive advantage therein also needs to be explored. AI and technology has far-reaching ripple effects, but of course can also continue to propel the growth that we've seen. Much of the theme, Yvonne, as I come to you, has been focused on where we're attracting capital from, how various markets and regions are being viewed on the continent, but what do we need to do to continue to deepen our capital markets, liberalize funding and financing, especially from areas such as the pension funds industry? We've got various players who are present here, but how best do we need to approach that from a regional point of view?
So we're in a situation where debt is an issue in several African countries. Half of the countries in sub-Saharan Africa have debt servicing costs of above 20% of their revenue. And at that point, your external debt servicing costs become pretty high, and you start looking inward for resources, which is towards your domestic institutional investors. So what you'd like to see there is modernization of prudential investment rules. Because at this stage, we find that a lot of most domestic institutional investors are investing in short-term assets, so basically money markets. And what you'd like to see is modernization, essentially raising of that allocation, so that you see some of those assets going into infrastructure, into project bonds, providing basically some of that long-term funding that's required domestically. But it needs to be done in such a manner that the rules or the regulations put trustees in a position whereby they feel that they can comfortably invest without breaching their fiduciary duties.
100%. Very important themes. And the truth is, when it comes to talking all things macroeconomics, we'll never get to all the topics at hand in one panel discussion. Hence, we have conversations throughout the course of the next 2 days. But fundamentally, the themes and the concepts have been put in place for us to understand how, regardless of whether you're influencing policy, you're shaping the monetary policy stance, critical decisions as to where to invest, or in certain sectors that enable and help facilitate growth, is that we all need to be aware of how the global macroeconomic themes do contribute to the fundamental decisions we take within this region. I do want to ask one closing question as your final remarks in the interest of time for this panel discussion. And this one perhaps is one that I think many of us might consider when we think of the spaces that we operate in. If you had to be finance minister of any country on the continent for one day, and you had $1 billion revenue windfall, where would you invest it to ensure that there's resilience in your economy by the year 2030? Yvonne, let's start with you as we make our way down.
I think I'd pay down debt.
Simple. Pay down debt. Michael?
I'm assuming you actually do have access to the sea. Ports. They are the mouths of nations.
Ports. Investing in ports. Gula?
Enhance governance. Enhance the rule of law.
enhance the rule of law. So to the finance ministers in the room, deputy finance ministers, if you have the ear of any finance minister, I think you've got 3 themes that you can potentially discuss with them during our networking sessions available here today. So please do be active and of course engaging in the various themes that we've discussed. But I hope that this does help you set the tone and the theme for many of the themes that we need to be mindful of as we continue to engage with many of our peers on the continent and from the world over the next 2 days. To Gulam, Michael, and Yvonne, thank you so much for indulging us in your time and your knowledge, shifting gears and, of course, themes that we've discussed here, and, of course, for the questions that have come through to give us some certainty as to what weighs heavy on your minds in ensuring that the continent remains competitive.